Hello, I wanted to spend a video going over the loan estimate. Loan estimate is required, usually goes out pretty quickly on a purchase or refinance transaction, at least for regular mortgages, conventional FHA, VA, USDA, etc. Non-QM things may or may not require a loan estimate, but we're going to go through one anyway. So this is a standard loan estimate. I have redacted all the proprietary information or specific information for this particular client, but loan estimate goes out and it has an issue date up here, has the property address in question there, and if it's a purchase or if it's a refinance, it'll have the estimated purchase price or property valuation there. Loan term 30 years for this one. Different term it'll say differently. Purpose, refinance, purchase will be the other option there. Product, fixed rate or adjustable rate mortgage will be there. Loan type, conventional, FHA, VA, or other primarily being USDA. Whether the rate is locked or not, this particular one, the rate is not locked. So in this particular one, property value $500,000, loan amount of $375,000, which is 25% equity or 75% loan to value. This is a cash out refinance on an investment property using a DSCR, a specialty investment property type product, and that's why the interest rate is 9%, but it shows you very clearly here, can the loan amount close after closing? No. Can the interest rate close after closing? No. Monthly principal interest, that's just simply amortization over 30 years of $375,000 at 9% interest. Whether there's a prepayment penalty, and again, this one is a specialty product, so it does have a prepayment penalty, but it does not have a balloon payment. Majority loans will say no in this prepayment penalty box. Next section, which is projection payments, will say the years it is involved, the principal and interest. Again, the straight math, this number matches this one, and the estimated escrow. So if we are capturing the property taxes, homeowners insurance, and mortgage insurance, that will be listed here in the escrows. And then this number reflects the principal and interest plus the estimated escrows. One of the things that comes out a lot is, why is this number after the fact, and does it add to this? Well, no, this number here, the estimated escrows, is listed right there. If there's an HOA, this may say $450 as an example, but we're only going to be collecting $250, so there would be a potential difference there. It does show that property taxes are escrowed, homeowners insurance are escrowed. In this particular one, estimated closing costs are $22,765. We'll go through that in a second. And the estimated cash to close is $352,235 to the borrower. So again, this is a cash out refinance. This is what the borrower is going to be getting. Section A, origination charges. So these are only fees or are fees specifically attached to the funding and origination of the loan. And this includes any broker fees, processing fees, etc., etc. This does have 0.879% of the loan amount in points paid through $32.96. An administration fee, which is often an underwriting fee of $10.75. Broker fee, so this is borrower paid compensation. If you're a broker, you'll know what this is. If you're working for a retail lender, or if you're working for a large, or if you're working with a large retail lender, you won't see this number there. That is hidden in the back end fees. And then non-QM funding fee of $350. Again, that's specific because this is a non-qualified mortgage. Services you cannot shop for. The appraisers and appraisals are always ordered by the lender, and so that's how that's in. That's why you cannot shop for those. You used to be able to shop for those before the 2008, and that's why 2008 happened. So you can't shop for those anymore. Title fees, you can shop for title fees. Now this is an important piece here, is that generally speaking, if it's a purchase, the title fees will be, the title company chosen will be chosen by the sellers, usually the seller's real estate agent. So that's where it comes from. In a refinance, the borrower can choose a title company. In this particular instance, I have chosen the title company with permission of the borrower. Moving up to, so this gets you the total loan cost of $19,442, and again, you look at this $22,765, you see that $19,442 in loan costs is listed there, and that's the total of this column right here. Other costs, we've got taxes, recording fees, county fees, etc. We've got prepaid, so we do have to capture mortgage insurance premiums up front, possibly. Homeowner's insurance premium up front, possibly. Prepaid interest, depending on the day you close, almost certainly. And property taxes, possibly. So it really just depends on what's being captured there. At this point in the loan estimate, all we have is that we're capturing monthly interest for 23 days. So that's that number there. We are setting up an initial escrow at closing with homeowners insurance of $125 a month for 4 months, and property taxes of $125 for 4 months. So our initial escrows is going to be $1,000 right there. So if you add these three together, you get that $33.23. If you go back up here, you see $33.23. Add it to the $442, gets you that $22,765. Most of these documents loop back and forth amongst each other, but they should all match. All the math should always match out. Going down, loan amount minus the closing costs gives you the cash the borrower is going to receive, and then the estimated closing costs are again reiterated right there. Moving on to the next page, this page that most loan officers don't like to talk about because it shows you how much somebody's going to be paying in interest. So over 5 years of payments on this note at 9%, borrower's going to pay $202,608 in mortgage payments, and that's principal, interest, mortgage insurance, and loan costs. And they will only have paid off $15,449. Always in your best interest, if you can put a little bit more towards the principal every month, which is your choice, you can accelerate all kinds of things that way. The annual percentage rate is APR is 9.494%, and so what that is we are amortizing the 9% interest rate at the loan amount of $375. In addition, we're adding in the cost for the loan over the term of the mortgage, and so that's why this is almost always higher. You do want to get this pretty close to the 9% for the actual interest rate of the note. You want to get that as close as possible. That means the fees are pretty low, and this is a non-QM cash out refi, kind of a unique circumstance, but even that is still not terribly bad. This total interest percentage, the tip, this will show you that if you pay this particular mortgage 9% interest, $375,000 for 30 years, you will pay 190.233% of the loan amount in interest, meaning you're going to pay almost 200% of the loan amount in interest over 30 years, meaning that $375,000 loan is going to cost you $375 plus $375 plus $360 or something like that. So this $375,000 loan probably going to cost about $1 million if you paid it 9% over the entirety of the 30 years. Moving down, other considerations, we may order appraisal. In this case, we put fees in there to order appraisal. We will not allow this loan to be assumed. This is not an assumable loan. Assumable loan means that if you have somebody else who wants to take over the loan and take over your house, you can just sign some paperwork and they do it. They take on paying from there. This loan will not allow you to do it. The loan does require you to have homeowners insurance. This will have a 5% of the overdue amount penalty if you're late on the payment past 15 days. If this property is foreclosed on, there is no protection for you because you lose this protection after foreclosure. Please talk to a lawyer. Refinancing a loan is a possibility, but again, remember up front, this particular one did have a prepayment penalty, and this particular lender is intending to transfer the servicing of the loan. Borrower does have to sign and date this particular one. There's some additional things on the last page regarding title and appraisal fees. And again, I've blacked out. So again, the loan estimate is a good starting point of numbers. It's almost always high in my case. I almost always estimate these numbers high. I would rather err on the side of them being high to begin with and be lower at closing than the other way around. Definitely talk to your lender and see what they offer and what it looks like. But every loan estimate is going to be slightly different, specific to the people, the loan amount, the interest rate, title fees, etc. But it gives you a general idea of what to look for in a loan estimate. Thanks a lot, and I hope you find this helpful.